Alright, welcome back again to my YouTube channel, Study with Clef. My name remains Caleb, and today we'll be looking at another important standard, which is IAS 37. Please, if you are new here, please like, share, and subscribe. Thank you very much. So, IAS 37, Provisions, Contingent Assets, and Contingent Liabilities. Provisions, Contingent Assets, and Contingent Liabilities are also an important standard, very important. And so, provisions, we have the key item of what we'll be discussing today, which is the definition, the recognition, the onerous contracts, contingent assets, contingent liabilities, and areas of judgment. You as an accountant or you as the finance controller of a particular entity, those places where you should be able to decide on your own to raise judgment as a professional accountant are regarded as areas of judgment in relation to IAS 37. So moving forward, the definition of provisions. Provisions are liabilities of uncertain timing and uncertain amount. So they are just obligations which are set aside, more like an allowance, set aside with an uncertain timing and uncertain amount. So in other words, provisions are just allowances kept for a particular obligation yet to take place in future, of which has no certain timing. It has no certain time of when it will actually occur, and it has no specific amount. It can only be estimated. You cannot really tell exact amount which will be actually settled for. So that's provision. The definition of provision which we've talked about. So in moving forward with that, provisions, we said we have no uncertain timing and then no uncertain amount. So for us to have an uncertain timing and uncertain amount, so provisions, we said they are liabilities. We've already talked about liabilities before when we were doing the elements of financial statement, which is the first class. So liabilities of uncertain timing that is going to take place in the future, but we don't know when exactly it's going to happen. So liabilities of uncertain timing and uncertain So provisions are liabilities of uncertain timing and uncertain amount. So if we have an uncertain amount, so it means we may make an estimate or we may provide for an obligation which is going to take place in a particular time, at a particular time in the future, but we don't know the specific amount. This will lead us into over provision and under provision. Over provision, we've talked about over provision recently when we did IAS 12, which is income tax. We talked about over provision. Over provision means you have provided for a particular obligation or an event which is to occur at a particular time, which you don't know, obviously. So you provided for an amount which at the date of settlement you paid lower than what you have provided for. So it means you have over provided for what is to be settled for. So at the date of settlement, you spent lesser than what you have provided for. So that's over provision. So over provision arises when you have overestimated an amount for an uncertain event. So that's over provision. The opposite is for under provision. So under provision arises when you provided or you make an allowance for a particular obligation, or of which at the date of settlement you paid more than what you have set aside. So that's under provision. So when you pay more than what you have set aside, you have under provision. But when you pay lower than what you have set aside for a particular transaction or an obligation, then you have over provision. So we have the treatment of this, but when we get there, we'll do justice to them. So let's take them one by one. So there are ways by which we pass entries for over provision, and also ways by which we pass entries for under provisions in accordance with IAS 37. So that's for that. That's the definition of provisions. They are liabilities of uncertain timing and uncertain amount. So in recognition, So the recognition of provisions in accordance with IAS 37, it is very synonymous to actually more like a liability. We've talked about liabilities before. The recognition of a liability is that of the recognition of a provision. So one is that there must be a present obligation. So one of the recognition criteria of provision is that there must be a present obligation. Present obligation means that there must be an uncertain or there must be an event which must be settled. So we don't know when it's going to be taken care of and we don't know how much we are going to spend. But there must actually be at a particular time or at this present time, there must be a particular obligation to be settled, of which we don't know when it's going to be settled and how much we are going to spend in respect of this obligation. So that's present obligation. Something must have actually occurred as at now. So that's present obligation. So present obligation can be divided into two, which is divided into legal obligation and secondly, constructive obligation. So we say present obligations, they are events of occurrence. So there's a certainty of an event or there's a certainty of an obligation to take place in the future as at now, this present date, which can now be in the form of legal or constructive. So legal obligations are obligations in relation to contracts and court cases. So when you have, for example, court cases to be settled in the future, or you have a contract to be arranged, which you will pay, you will make some certain amount for. They are regarded as legal obligations. So examples of legal obligations are contracts and also court cases and many more like that. While constructive obligation arises as a result of past history of an entity. So when you have a particular constant or a consistent occurrence of a loss, for example, in an entity, then you can make constructive obligation. For example, if I'm into trading now and every year out of my inventory, I used to have at least 20% damages of all of my inventory every year from past records. So I can now begin to make a constructive obligation for this. So I can begin to make an allowance for that damages, even though they have not occurred. So because in past or in past times, few years back, we usually make losses of 20% as a result of damages on inventory. So we can begin to make constructive obligations on such cases. So example of constructive obligations are like damages, although meaning that so constructive obligation have to be as a result of history. So losses as a result of history, consistent losses as a result of past histories are regarded as constructive obligation. So when we make constructive obligation for an occurrence due to past history or past events, they are regarded as constructive obligation. So example of them is the normal loss, or you make provisions for loss or for damages. So that's for constructive obligation. So that's one of the recognition criteria of provisions. Secondly, it must be probable that future economic benefits will flow from the entity. So secondly is that it must be probable, there must be a probability that we will spend a certain amount. So it must be probable that future economic benefits will flow out of the entity, will flow from the entity. Economic benefits are regarded as increase in income or reduction in cost. So if there will be an outflow of economic benefits, then it is part of the recognition of provisions in relation to IAS 37. So lastly, as part of the recognition is it must be of best estimate. So lastly, as part of the recognition of provisions, it must be the amount set aside. We said we have an uncertain amount, an uncertain timing, and an uncertain amount. We cannot actually predict this amount, but that amount must be reliably estimated. So it must be of a reliable estimate. So it must be best estimated, even though it would not be completely perfect, but it must be reliably measured. So that's part of the recognition criteria for provision. So one is that there must be a present obligation, which can be in a form of legal obligation or constructive obligation. Secondly, it must be probable that future economic benefits will flow from the entity. Before you can make a provision for a certain occurrence or an event, then it must be probable that future economic benefits will flow from the entity. Then lastly, it must be of a reliable estimate. So it must be best estimated. The amount which you are setting aside for that obligation must be reliably measured. So that's for that. These are the recognition criteria of provisions, which are synonymous to recognition criteria of liabilities. So moving forward, we have something called onerous contract. So onerous contract is an information in relation to IFRS 15, which is revenue from contracts with customers. This is an aspect of IFRS 15, revenue from contracts with customers, which we've not done, but we're coming to it. But onerous contract means a contract which has a possibility of resulting into loss in the future. So onerous contract, we have a particular contract, but there's a tendency that we will run into loss at the end of the completion of this particular contract. So that's regarded as onerous contract. So onerous contracts are contracts with the highest possibility or with a high probability of resulting into a loss at the completion of the project or at the completion of the contract. So in relation to that, when we have said that onerous contracts, they are contracts with possibilities of resulting into a loss at the completion of the contract. So like I said, onerous contract is an aspect of IFRS 15, which is revenue from contracts with customers. But this is what onerous contract means. It's a contract that will yield or that will result into a loss at the completion of the contract. So for example, we've collected a contract of 50 million, but at the end of the day, we will spend about 60 million to complete that contract. So it means we will actually run into a loss of 10 million. So that particular contract is regarded as a onerous contract. So a contract that will result into a loss at the completion of the contract is regarded as onerous contract. So IAS 37 provision as regards onerous contract. So provisions in relation to onerous contract. So provisions are not to be made on this type of contract, which is a onerous contract, a contract that will yield loss at the completion of the project. Provisions should not be made for onerous contract because they are not as a result of past events. They are things that will happen in the future. They are not as a result of past events. Before we can make provisions for a particular obligation, then it must be as a result of past events, which is synonymous to a liabilities. That's part of the definition of a liability. The liabilities are obligations as a result of past events in which future economic benefits will flow from the entity. So they must be as a result of past events. Onerous contract is a future event. It is not as a result of past event. So we cannot make provision for a onerous contract. That is just what we are trying to emphasize on. So that's the most important part which we are trying to lay foundation on. So onerous contracts are not going to be provided for. So we don't make provisions for onerous contract. If it had been IFRS 15, which is revenue from contracts with customers, there's a way we treat onerous contracts. We absorb the losses, future losses into present period. So, but that is for IFRS 15, which when we get there, we'll do more justice to them. But in relation to IAS 37, this will result into loss, but we must not make provisions for onerous contracts because they are not as a result of past events. They are future losses. So that's for that. So journal entries for provisions now. How do we show the journal entries for provisions? How do we reflect or how do we represent them on the face of the account, on our financial statement? How do we show them? So let's just show an illustration on how we are going to present a provision in the books of our account. So here we can say that the journal entries for provisions. So if these three recognition criteria are met, meaning that if there is a present obligation as a result of past events, note, it has to be as a result of past events. Then if it is reliably measured, then if there is a probability that there will be an outflow of future economic benefits, then we should recognize provision. So we now said, how do we recognize the provision? So at the initial stage of recognizing provision, provision is an expense and it is also a liability. Just like we have said that provisions are liabilities of uncertain timing and uncertain amount. So here, he said, so at the date of recognition, the initial recognition, we will debit the provisions as an expense. Profit or loss, which is an expense now, and will credit liabilities. So that's at the initial stage, we will debit the provisions to an expense. That's in the statement of profit or loss. We debit it, then we'll credit it as a liability to the statement of financial position. So this is for statement of profit or loss. This is for statement of financial position. So that's that. This is at the initial stage. Now, at the date of settlement, so at the settlement date, how do we recognize provision? So this will lead into two different information. So if at the date of settlement, we paid more than what we have provided for, remember that when we talked about this before, that when we pay more than what we have provided for, it means we have under provided. So in a case of under provision means we have paid more than what we have provided for. We made a lower estimate for an higher amount to be settled in the future for an obligation. So that's under provision. So if at the date of settlement we have under provided, meaning that we paid more than what we have provided for, then we will debit, we have initially credited liabilities. Now, at the date of settlement, we will derecognize the liability by debiting liabilities. So, the amount which we have recognized as liability initially will be deducted, will be removed from the liability because we are settling it now. So, we will derecognize the liability, that same amount. Now, we said we paid more than what we have provided for. So, it means what we recorded as the liability is not up to what we are going to pay. So we'll take the remaining amount, that's the excess, we'll debit it to expenses. which is P or L. So this is what we provided for. We have recognized it. Now the excess, because we paid more than what we provided for, the excess will be charged to statement of profit or loss as an expense. So that's for that. Then it will all be credited to our cash or bank. So crediting cash or bank means there's an outflow of cash or bank, whichever the case may be. So that's what it is. So if we have under provided for a particular transaction or an obligation, we will debit the initial liability, which is the initial provisions from our liability. So we're debiting liabilities, which is provisions now. So we will remove what we have previously recorded as a liability. We would recognize it because we are settling. Then we will take the excess, which is the remainder. We said we paid more than what we have provided for. The remainder now will be charged to statement of profit or loss, which is an expense. We will debit expense. Then the whole amount is taken from cash, which is cash or bank. So we are crediting cash or bank. So crediting cash or bank means we are removing from cash or bank. So that's that. So this is in the case of under provision. So in case of over provision now, so over provision means we have made allowance more than what we eventually paid. So we have overestimated our provisions. That's just the meaning. So it means we have made an allowance for something which we paid lower amounts for. So in the case where we paid an amount which is lower than what we have provided for, then we will debit. Remember that we have previously recognized provisions as a liability. This is at the initial stage. So we would recognize this liability because we are settling it. We said at the date of settlement, it can result into under provision or over provision. So if it is over provision in this case now, it means we have made provisions higher than what we are supposed to pay. So we would recognize the liability. The whole amount will be taken out of liability. That's the recognizing the initial provision. Then we will credit the excess. Now we said we have provided more than what we needed. So the excess will be taken to income, which is other income, which is the excess. This is P or L now. Remember that this is the excess. This expense is also the excess. Then the actual amount that was settled for will be removed from our cash or bank, which is the actual amount that we paid for settlement. So this is in the case for over provision and this is the case for under provision. So let me just cite an example on this. So let's assume we have a transaction, we have an obligation to settle in the future, and which we made provision of 20,000. 20,000 is what we have recognized as our liability. And we said, well, it's an expense. We also recognize it as an expense. So if, for example, we have an obligation, let's say a court case, and we provided for 20,000. So meaning that we have an obligation to settle 20,000 in the future. We said it must be reliably estimated. So it has been reliably estimated that we will spend 20,000 for a particular court case in the future. So at that stage, we will debit the provisions as an expense to P or L, 20,000. Then we will credit liabilities, which is provisions, 20,000. That's at the initial stage. So subsequently, so at the date of settlement now, that's at the date which we actually want to settle this obligation, the court asked us to pay 30,000. So at the date of settlement, we are told to pay 30,000 for the obligation. Remember that we have made a provision of 20,000 initially. Now we are to pay 30,000. So it means that we have under provided. This means if we are to settle 30,000, so for example, we have to settle 30,000 now. So it means we have under provided. We have initially recognized provision as 20,000. Now we are to pay 30,000 for this same obligation. So we have under provided for this particular obligation. So in the case of under provision, we said we will debit the amount. We will recognize the whole of this 20,000. We recognize it. The excess will be taken as an expense, charged straight to profit or loss, which is an expense, which will be 10,000. Now we will take what we actually paid is 30,000. So let's show that. So we will debit what we have initially recognized as a provision. So we are debiting the whole amount initially recognized, 20,000. So we are told to pay 30,000, meaning that we have under provision of 10,000. We have under provided 10,000 for this particular obligation. So the remaining 10,000 will be charged as an expense to P&L account. So we have 10,000. Then what we actually paid now is 30,000. So what we are removing from our bank is 30,000. 30,000. So that's in the case of under provision. So let's now assume that at the date of settlement, we are to pay 15,000. Remember that we have provided 20,000 for this obligation. So the court now asks us to pay 15,000 for settlement of the same obligation. It means we have over provided for that obligation, which is an over provision. So if we are to pay 15,000 for the settlement, we have initially provided, if we are to pay 15,000, we have initially recorded 20,000 for this same obligation, meaning that we have over provided for this obligation. So we said we will debit the whole initial provision which we have initially recognized as a liability. So we will debit 20,000. Then the remaining amount, what we are paying now is just 15,000. We have an obligation we have made a reservation of 20,000, but what we eventually paid is 15,000. The remaining 5,000 will be taken as an income to the P&L account, which is profit or loss. So 5,000 will be taken as an income, while what we actually paid is just 15,000. So that settles it. So we said we would recognize the previous recognition of provisions. So we would recognize the provision which we have initially recognized. So we said we are to pay 15,000, meaning that there is an excess of 5,000 which is with us now, which we are not going to pay. So that 5,000 will be taken as an income to P&L account. So we charge 5,000 to P&L account, which is an income. Income means that is why we're crediting it. Crediting income means we're adding 5,000 as an income. Then what we eventually paid was 15,000. So we're crediting our cash or bank with 15,000. We said crediting cash or bank is like deducting from cash or bank. So this is the case where we have the recognition of provisions in our financial statements. So that's for that. So then we can move forward to the next, which is contingent assets and contingent liabilities. So contingent assets now. Contingent assets are possible assets which arise as a result of past events whose recognition in the financial statements now depends on the occurrence or non-occurrence of a future event. So the occurrence or a non-occurrence of an event determines whether we will have a contingent asset or not. Contingent assets are just possible assets which can be generated for company. For example, there is a probability that we will have a particular asset in the future. So contingent assets are possible assets which arise as a result of past events on which their recognition depends on the occurrence or non-occurrence of a future event. So the future event determines whether we'll have contingent assets. So we said contingent assets are these are possible assets arising from past events whose recognition in the financial statement depends on the occurrence of a future event. So that's contingent assets. They are possible assets arising from past events. Just like the definition of assets, we said these are resources as a result of past events. So automatically they must be as a result of past events. Something must have happened for us to be able to have this particular thing as an asset in our statement of financial position, which is to be recognized. So for us to have an asset, there must be a past event. So it must be recognized. It cannot be recognized in the financial statement depending on the occurrence of a future event, occurrence or non-occurrence of a future event. So that's for contingent asset. So for contingent liability now, contingent liabilities are present obligations also arising from past events whose recognition in the financial statement also depend on the occurrence or non-occurrence of a future event. So we have an obligation which we will settle in the future, but it depends on whether something happens or not, which will happen in the future. So it has been stated that we have an obligation which is as a result of past events, then depending which will be recognized in our financial statement, depending on the occurrence or non-occurrence of a future event which is yet to take place. So that's contingent liability. These are possible obligations arising from past events whose recognition depends on the occurrence or non-occurrence of a future event. So that's contingent liability. So that's contingent assets and contingent liability. So in all cases, we said they depend on an occurrence or non-occurrence of a future event. So it means there is no certainty that this thing will actually come in place or that this particular obligation will actually occur. So if there is no certainty, both contingent assets and liabilities, which is something that's taken into consideration, in cases of contingent assets and liabilities, both of them, since they cannot be 100% guaranteed, they are not 100% guaranteed, then both of them should not be shown on the statement of financial position. So both of them should not be recognized in the financial statement. What they should only be recognized in is a disclosure. They should be disclosed as a note to the account. They should be disclosed as a note in the financial statement. But they should not be shown, they should not be recognized as an asset or as a liability, since they do not have 100% certainty. So both contingent assets and liabilities, they are to be disclosed in the notes to the account to the financial statement. So that's one important thing to take note of. So we do not recognize contingent assets and contingent liability on the face of the account. So they will not be shown as an asset in the statement of financial position, neither will they be shown as a liability in the statement of financial position. So they should only be disclosed as an information in the notes to the account. So that's for that. So now to the areas of judgment. So the areas of judgment mean that you as an accountant, those places which you should actually be able to determine yourself. There is no principle or there is no particular policy relating to it, but you should be able to detect these particular things as a professional accountant. So the areas of judgment in relation to IAS 37, which is provisions, contingent assets, and contingent liability. One is that you should be able to determine if the provisions, at first, for provision, if there is, should be able to determine if there is a present obligation. So you as a professional accountant should be able to ascertain if there is a present obligation. That's one. Secondly, you as an accountant in relation to IAS 37 provisions, contingent assets and contingent liability should be able to determine if there will be an outflow of economic benefit. So you should also be able to note if there will be an outflow of economic benefit. And lastly, you should be able to determine if the provision is reliably estimated. That's the amount which is set aside for this provision, if it is reliably estimated. So before you can recognize all of this, you as the professional accountant should be able to ascertain all this particular information. So it should be noted, you should be able to ascertain if the amount is reliably estimated. So these are the areas of judgment required by a professional accountant in relation to IAS 37, provisions, contingent assets, and contingent liabilities. So one of them is that you must be able to ascertain if there is a present obligation to settle a particular transaction. So you as an accountant or you as the financial controller should be able to ascertain that as a professional. Secondly, you should be able to identify if there will be an outflow of economic benefits. Then lastly, you should be able to ascertain if the amount which you are setting aside is reliably estimated or measured. So these are all in relation to IAS 37, provisions, contingent assets, and contingent liabilities. So we've talked about the definitions of provision, we've talked about its recognition, we have the consideration of provisions in relation to onerous contracts, which we said onerous contracts are those contracts with tendency or probability of resulting into a loss at the completion of the contract, which we will not be making provisions for because they are of future events. They are not as a result of past events. We've talked about all of these things. They also talk about contingent assets and contingent liabilities. So contingent assets are possible assets which arises as a result of past events whose recognition is dependent on the occurrence or non-occurrence of a future event. Same for liability. There are obligations which arise as a result of past events whose recognition in the financial statement also depends on the occurrence or non-occurrence of a future event. Then we talked about the areas of judgment. Now we'll be looking at the illustration from corporate reporting November 2021, question 4A. So to the question now, corporate reporting November 2021, question 4A. So you are the financial controller of Feedpot PLC, a bottling company with diverse products. The accountant responsible for preparing the 2020 annual financial statement is considering the accounting treatment of the following and has approached you for guidance. Now, on December 31st, 2020, Feedpot PLC has a litigation proceeding involving a customer claiming damages in the sum of 50 million because she had allegedly been injured when drinking one of the company's products. She had claimed that the company bottled a sharp object inside the contents of the product, which she swallowed and had to be operated upon in order to remove the object. Fitport PLC is disputing the claim, maintaining that any injury was due solely to negligence on the part of the customer. As at December 31st, 2020, the case was yet to be decided. So, as the financial controller, how will you regard this case? And in relation to IAS 37, this particular question is solely on IAS 37. So, which is provisions, contingent assets, and contingent liability. So, at first, the litigation should not be recognized as a provision. It should not be recognized as a provision, but should be recognized as a contingent liability because of the following information. If you check the question, they said the person claimed the sum of 50 million. One of them is that it is not reliably estimated. It cannot be reliably estimated. That's one, which is why it cannot be a provision. It is a contingent liability. Then secondly, it is as a result of future events. It is the recognition will be depending on future events, which is the court case now. The claim should not be recorded on the face of the financial statement as provision, which is a liability, but should be taken as a contingent liability, which should be disclosed as part of the notes to the financial statement, because it cannot be reliably measured, and also it is dependent on a future event. So it is not as a result of past event, but it is of a future event. So it should be recognized as a liability and not a provision. So that ends IAS 37 in summary. Thank you for staying by with us. And in case of any other question relating to IAS 37 or any standard, please feel free to use the comment section. Thank you very much. Once again, my name remains Caleb, and this is Study with Clef. Please like and share to as many as possible people. I mean, there are many people that may still need to see this, especially those preparing for ICAN examination and other professional examinations. So thank you very much. Please like, share, and subscribe. And I hope we will see you in our next video.